Okay. Hello everybody. Good afternoon. Thank you for joining us. So today we've got our dialogue series on goodwill and impairment, science, art, or fiction. My name is Sabine Schürer. I'm a senior manager here at the AASB. And before we dive into the session, I would like to go through a bit of housekeeping. So the dialogue series is jointly held with CPA and CAANZ, and our chair for today is actually the reporting and assurance leader of CAANZ, Amir Ganda. I would also like to highlight that the views that we are sharing in this session are not the views of the presenters organization, but are their personal views. And I would like to encourage our audience to participate, comment, and ask questions via the Q&A function. And we will aim to address these questions towards the end of the session. So as I mentioned, today's topic is goodwill and impairment, important, very complex topic, which is also keeping the AASB busy at the moment with their project on business combinations, disclosures, goodwill and impairment, where the board is currently deliberating the feedback that he has received on its ED. And some of that feedback has been mixed. And so the AASB really has, or AASB staff have decided to undertake further consultation on a few issues. And that's really an opportunity for our Australian stakeholders to provide feedback into this process. And while this won't be an open consultation, obviously the AASB is always happy to pass on that feedback onto the AASB. In addition to considering the recent developments there, we will also touch on the continuing debate on amortization versus impairment. I would like to highlight here that the AASB has decided to progress with the impairment approach, but because there's still much support for the amortization approach, we thought that it would be important to sort of recapture some of that discussion and maybe learn why the AASB has gone down the path. As customary, we begin with a researcher presentation on the topic. So today we have Dr. Mark Wallace, who will share his insights into how Australian companies conduct goodwill impairment testing under AASB 136. Mark is a senior lecturer in accounting at the University of Queensland, and his research focuses on financial statement analysis and the interaction of financial accounting information in financial markets. Mark has published widely in leading academic and professional journals, and I'll hand over to you, Mark.
Okay, thank you, Sabine. I better share my screen, I think. So can everybody see that? Yes, you should be able to see that. Okay, so I'm going to present the findings of a report that I did with Professor Matt Pinnock. It's quite a long report that we put together, so this is going to be a very short summary of what we did. So I can provide more details in questions if anyone's interested in more details about what we actually did. So basically, we're looking at goodwill impairment testing and how Australian companies are carrying it out and what they're disclosing in their annual reports. So the first question is, why were we interested in this? And the answer is that it's an area that generates auditors and regulators are spending a lot of time on it. So it's the most common key audit matter in Australia, goodwill impairment testing, outside of the mining industry. And it's the most common topic of ASIC inquiries. So it seems to be a difficult area of accounting. And as you can see in this graph here, I've graphed goodwill against PPE over time. And you can see that goodwill has grown relative to PPE for non-mining companies, non-financial companies, Australian companies. So it's growing economically in importance. And the other point that was interesting for us was, if you look at the feedback that the AASB receives, a lot of users claim that goodwill impairments are often delayed. So that's an accusation that's out there as well. Now, it's also interesting because there's a lot of judgment and estimation involved in goodwill impairment testing. So this slide sort of lays out, I think, all of the major judgments that a firm would have to make in applying the impairment test. And so this is interesting for us as researchers because we can collect a lot of this data, sort of see what it looks like. So I've listed them all here. I'll go through this because this is also the sort of data that we collected. So the firm would first of all have to decide what its cash generating units are. then allocate goodwill to the cash generating units, and then the cash generating units are tested for impairment. Would then have to decide whether to estimate recoverable amount of the cash generating unit using value in use or fair value less cost of disposal. So most firms end up using value in use, and that turns out to be basically just a discounted cash flow valuation of the cash generating unit. So a firm will have to forecast the cash flows for the cash generating unit for several years, normally 5 years, and then discount those to present value using an appropriate discount rate. So they'll have to estimate the discount rate. And they'll also have to decide on the appropriate terminal growth rate. So that's the rate at which the cash flows are expected to grow forever beyond the forecast horizon. So a lot of decisions here, a lot of estimates that have to be made, which will be usually quite uncertain. And of course, the other issue is around whether this should be done pre-tax or post-tax. So they have to decide whether to use pre-tax or post-tax discount rates and cash flows. I think at the moment in the standard, it says they're supposed to use pre-tax discount rates and cash flows. The alternative is that the firm will estimate the fair value less cost of disposal, but that turns out most of the time to be similar to value in use. Most firms will choose the income method to estimate fair value, and then that more or less proceeds the same way as value in use. They tend to have to make the same estimates, and they tend to follow a similar approach to value in use. And then, so all of these things have to be disclosed, except the cash flows. Firms don't have to disclose their exact cash flow forecasts. We call this a quasi-voluntary disclosure. The standard says they have to provide details of what their key forecasting assumptions were, but they don't have to specify exactly what those forecasts were. All right, the other motivation for the study is that the academic literature. So the academic literature, a lot of it is focused on the idea of firms, that most firms are delaying goodwill impairments. A lot of evidence from the US particularly showing that. But a lot of this evidence is kind of indirect. So they'll look at the market value of the company and compare that to the accounting book value of the company and sort of say, does it look like there should be an impairment or not? So they don't normally go into the granular details and look at these sorts of estimates that firms have to disclose, like the discount rate and the terminal growth rate. So we wanted to do that. And for example, if a firm could overstate the value in use by underestimating the discount rate. So can we see that type of thing or not? If there's accusations out there that they're delaying impairments, can we see it in the estimates that they make? And of course, this also is sort of what an investor would have to do theoretically. So theoretically, the purpose of these disclosures is to allow investors to scrutinize the company's goodwill impairment testing assumptions. And so to what extent would they really be able to do that and tell if the firm had, for example, delayed a goodwill impairment that should have been taken? Okay, so what did we do very briefly? So we took 6 years of data. You can see there our sample period 2018 to 2023, so it includes the COVID period. We looked at all Australian companies that met these requirements here. So we set a minimum firm size so that we could keep the data collection manageable. And we required the firm to have material goodwill, which we defined as goodwill of total assets of more than 2%. So we end up with 1,800 observations. This represents 83% of the goodwill that was on Australian public company balance sheets at this time, so during the sample period. So it's very comprehensive. And I think this is the largest academic study of goodwill impairment testing assumptions, the actual granular assumptions that's in the literature. I couldn't find a bigger sample. Okay, so I'm going to run through our findings very briefly. So this is just some descriptive statistics. So most firms allocate their goodwill to 1 to 3 cash generating units. And then most firms will choose value in use. So you can see it's 84.5%. So the vast majority of firms are using value in use in the first instance. And then of course, if the value in use is greater than the carrying amount, they don't have to take an impairment. They don't have to estimate the fair value less cost of disposal. So firms seem to strongly favor value in use. For the firms that use fair value less cost of disposal, we found that most of them use the income method. So that ends up being very similar to value in use. It's another discounted cash flow type valuation. And firms tended to use the same type of assumptions and follow the same sort of guidance that they would follow for value in use when they did fair value less cost of disposal. Another thing we looked at is what kind of discount rates are firms disclosing. So the standard tells them to use pre-tax discount rates to estimate value in use, but we found a lot of firms disclosing only post-tax discount rates, and then there were firms that disclosed both pre and post-tax discount rates. So post-tax discount rate's probably going to be easier for investors to interpret. It's more similar to what we would do in corporate finance. So you estimate the cost of capital for a company and normally do that post-tax. So there seems to be a preference for that, and firms seem to respond to that. Now, we collected all of the assumptions, the value in use inputs that are mandatory disclosures. And the sort of conclusion of our analysis is that they seem to be conservative. So we don't find any evidence that firms are systematically using aggressive value in use assumptions for the assumptions that are disclosed. So the discount rates, for example, are higher than what we estimated. So we estimated discount rates ourselves and compared them to what the firms disclosed. They seem to be a little bit higher than what we would predict. And firms didn't aggressively cut their discount rates when interest rates in the economy went to record lows during COVID. So they didn't take advantage of record low interest rates to use very aggressive discount rates. They tended to look over the cycle and keep their discount rate at a normal level. The terminal growth rates firms use, so this is the long run growth rate of cash flows. You can see virtually every firm used a terminal growth rate of less than or equal to 3%. And that's quite low. We would actually expect, like, the long-term growth rate of the Australian economy is expected to be 4 to 4.5%. It's Treasury's best estimate. So most firms are predicting that the cash flows will grow less than that. So that's quite a conservative approach. And then the vast majority of firms follow the standard sort of suggests a 5-year forecast horizon, and most firms just stuck to that 5 years or use less than that. So again, that's quite conservative because they're not factoring in many years of high growth for the cash generating unit before it drops down to this low terminal growth rate. So there's not really any evidence from the observable, the disclosed assumptions that firms are being aggressive with their value and use assumptions. Now, the forecasts are the part that we can't really observe for most firms. So they're not required to disclose their exact forecasts. And most firms provide only vague information about their key forecasting assumptions. So they usually provide only qualitative disclosures. And if they do disclose information, it'll be usually top line numbers like revenue rather than profit. So they seem to be concerned about commercial sensitivity of these sorts of things. All right, now we conduct empirical analysis as well. Basically here we're trying to look at whether firms manipulate the timing of goodwill impairments, Australian firms. And the answer is that some firms do. So there's evidence that firms take a bath, so they bring forward goodwill impairments. For example, firms are much more likely to take an impairment during the first year of a CEO's tenure. So that would be a year where the CEO could take a big impairment and then blame it on the previous CEO. And then there's also evidence that firms are delaying goodwill impairments in some cases. So most firms that have a market value of assets that is less than the book value of assets, which is a strong indicator of the need for impairment, don't take an impairment. So I think it's about 2/3 of firms don't. So that's consistent with delaying impairments. And then another one that we looked at is to do with how the firm aggregates its cash generating units. So if they don't disaggregate their cash generating units to find very granular cash generating units, that's thought to allow them more scope to delay an impairment because they can kind of average out strongly and weakly performing areas of the business, combine them into one CGU and avoid an impairment. So we find that firms that do this and have less disaggregated CGUs are more likely to delay an impairment. So unfortunately, there is some evidence of firms manipulating the timing of impairments. Now, this is less likely where they provide very transparent key forecasting assumptions. So there were some firms that actually provided, for example, their profit forecasts or their cash flow forecasts. They were less likely to delay an impairment because it would be presumably quite obvious to investors. So what does it all mean? So essentially the mandatory disclosures, the one that firms have to make and normally do make, discount rate, terminal growth rate, forecast horizon, these seem to be usually conservative. But we do know that firms seem to be manipulating the timing of impairments, at least some firms are. So what this sort of suggests is that firms are perhaps manipulating the definition of the cash generating units, not defining cash generating units at a low enough level, perhaps not disaggregating them enough. And also that they might be manipulating the key forecasting assumptions, the forecasts, because we don't normally observe those as investors. So those could be too optimistic, for example, to delay an impairment. We can't see that. Now, how does this relate to the exposure draft that AASB has out? So the exposure draft proposes changes to IFRS 3 and IAS 36. Our study obviously speaks more to 36, but it's pretty I mean, we would support most of the propositions that are in there. So it's going to remove the need for firms to use pre-tax discount rates and cash flows. That seems to be a good idea because most firms, well, a lot of firms disclose post-tax discount rates, suggesting that they prefer those. And those would be easier, I think, for investors to understand than pre-tax discount rates. Firms will have to disclose whether their discount rates are pre or post-tax. That would seem to be a good idea because we did find a significant number of firms, you can see 9.3%, that didn't tell us whether the discount rate was pre or post-tax, and we couldn't work it out. It was ambiguous. And that's important because investors need to be able to see, do I like this discount rate assumption or not? They're going to remove, well, they're proposing perhaps to remove the prohibition on forecasting restructure enhancement of cash generating units. That might perhaps do something to reduce the conservatism we see in terminal growth rates, because firms seem to be factoring in no growth apart from inflation beyond the forecast horizon. And then there's this proposal to link the segments and cash generating units. So firms have to disclose which CGU segment which segment the cash generating units are related to. Maybe that will do something about aggregation of cash generating units. Just some other observations. So one thing that I sort of felt from having done the study is that it wasn't clear what the difference between value in use and fair value less cost of disposal was in practice. We saw vast majority of firms use value in use. The firms that did fair value tended to act most of the time as if they were doing a value in use. So to me, maybe it would make more sense to limit fair value to a scenario where the firm's intending to sell the cash generating unit. That would be where the market value of the CGU would be relevant. The disclosure formats were very varied. I hand collected a lot of this data myself, and it was quite hard. So it would perhaps be easier just to have a simple table of here's the cash generating units and here's the discount rates, here's the terminal growth rates we assume for each cash generating unit. I personally would favor just saying, let's just have post-tax discount rates and not continue with the pre-tax and post-tax. I think it'd be easier for investors to compare different firms if they all did it the same way. And then there's also a few extra options in the standard that we saw that were very rarely used. So firms are allowed, for example, to use an expected cash flow approach where they adjust the cash flows for uncertainty rather than the discount rate. We didn't see any firms saying that they did that. Firms are allowed to use, inflation adjusted or non-inflation adjusted valuation inputs. We saw very few firms saying that they were using real, i.e. inflation adjusted inputs. Probably be easier just to remove these options because very few firms do them anyway. And as an investor, you would need to know whether the firm had used this approach and have to disclose whether they do or not. For example, the interpretation of the terminal growth rate, it depends on whether it's adjusted for inflation or not. So anyway, I think I've taken up too much time. So it was a 100-page study when we did it. So that's as briefly as I can summarize it. But that's enough for me. So I better stop sharing my screen, I think. Yep, is that right?
Thank you very much, Mark. That was very insightful, and you definitely did not take too much time because it was very interesting to listen to you. So before I hand over to Amir, let me please introduce our illustrious panel for today. So we have Adam Soufoulis, who is CFO at Goodwill Lithium. Adam has extensive experience in the financial strategy and accounting area, including goodwill and impairment practices, and he has previously worked at Bunnings, Wesfarmers, and Deloitte. Most of you will also already know Professor Meredith Ann Tarkar, and was a member of the AASB until very recently, where she headed the Academic Liaison Initiative. And Anne was also previously a AASB member and a professor at the University of Western Australia. Then we have Janaya James, who is corporate finance partner, leading the specialist valuation team at Grant Thornton. And she has previously worked at Arthur Andersen and Ernst & Young on mergers and acquisitions, tax, and independent expert reviews. Martin Lawrence is a co-founder of Ownership Matters, a governance advisory service for institutional investors. And his previous appointments include Head of Research, Australia and New Zealand at ISS Risk Metrics, and Manager at Corporate Governance at the BT Governance Advisory Service. And Martin began his career as a financial journalist. So, and last but not least, we have Moana Overton, a current AASB member and partner of accounting and corporate reporting at Deloitte. And Moana has a very long history with Deloitte in Australia, New Zealand, and the United Kingdom, and specializes in providing accounting and reporting technical advice, both within the firm and to clients at the national level. Thank you very much for being with us today. And without further ado, Amir, the floor is yours.
Thanks very much, Sabine, and thank you, Professor Wallace. As always, a very enlightening presentation. Thanks also for, of course, all our panelists, as well as all of you who've joined the session online. And please do get those questions in. We'll certainly be leaving time to deal with questions from the floor. I'd like to acknowledge the traditional owners of the land we're coming out to you from. For me, that's the Gadigal people of the Eora Nation. What an amazing topic we have to talk about today on Auditor Proud Day of all days, and it's one that certainly exercises auditors and all of their clients, as well as the regulators. As Professor Wallace mentioned, this is a real conundrum. We've got an element of a crystal ball thinking about the future. We spend a lot of time, there's a lot of scrutiny around this. There are various different views around, how valuable is the information, how's it being used very, very differently by different stakeholders. So I think I'm looking forward to a discussion and unpacking a lot of this. So first, a question to all the panelists, and I'll go just maybe approximately on what I can, the order on my screen, so no particular order, but the research findings that we just heard about, they've identified some real challenges in goodwill impairment practices and reporting. Have you had similar experiences, and what sort of aspects stand out to you? Perhaps starting with Moana.
Thanks, Amir. So for my sins, for a long time, I led Deloitte's Impairment Task Force, which was designed specifically to address concerns that have been raised about the quality of impairment testing by clients and the audit work and how it was documented thereon. So the very fact we felt the need to set up an impairment task force probably tells you a lot about how tricky we find this. And it was a very hard journey to get from a place where we were finding a lot of things that were maybe not ideal to a place where we were satisfied that the impairment work had been done correctly and in accordance with the standards. However, if I then jump to the findings from Mark and say, well, some of the things that Mark has found and pulled out in that research as perhaps not a criticism, but an observation on various firms, we would still consider to be within the expectations of the standard. So for example, the use of post-tax discount rates. Janaea may have more to say later, but certainly when I speak to my corporate finance colleagues, they tell me that the notion of a pre-tax discount rate is somewhat of an eye roll, and they can't give us one because discount rates don't exist in a vacuum, as an example. So I suppose my overall perspective, summarising all of that, and I could talk cheerfully to the challenges of each of Mark's key points, but I'd rather hear from others as well, is that the impairment standard has been around for a long time, and it doesn't seem that regulators, preparers, users, auditors have come to a full meeting of the minds as to what does ideal impairment testing under the standard look like. And so for me, that sort of does indicate it's time for a bit of a look-see at what could we do differently that would get us closer to that meeting of the minds.
Mm-hmm. Thank you, Moana. And Anne, perhaps to go international, I know you've experienced in your role up till very recently as a member of the IASB, the International Accounting Standards Board, lots of those different views coming at you and different perspectives. What do you think about this looking from that global level?
Thanks, Amir. Well, certainly the IASB has heard the feedback loud and clear and has known the difficulties that preparers are experiencing, auditors and regulators, and indeed investors. So it's a well-known problem, and that's why it has stayed on the agenda for so long, and in fact has consumed a lot of resources, because the project that the IASB is working on now, that Sabine mentioned at the beginning of this webinar, comes out of the post-implementation review of IFRS 3. So we're going back many years. It's very well recognised. I think the issue has been the difficulty of finding a way forward, finding a way to address the issues that people are experiencing when, as Moana rightly says, so much judgment is involved in the process. So I think recognising that IAS 36 is an old standard, that there seems to be some anachronisms in there that are clear, and the post-tax one is one of those. So that's ripe for doing something. I'd really like to credit Mark and Matt for their research. I think this type of work is so useful for standard setters to have this fabulous snapshot. So in the research as presented, there's some things that are not surprising that are quite consistent with what we've seen from the large body from the US. And that's the things like the CEOs taking the big bath in the first year, delaying impairments, the book values are greater than market values, but still no impairment appears. So various things like that. So this research for Australia is consistent. But I think that this particular work from our two academics here is very valuable for bringing up the detail, and all credit to them for going into the disclosures and actually reading what companies are doing. This is so valuable for standard setters, because part of the project that the IASB will do will have a disclosure element to it. Aside from making changes to the standard, there'll be changes around disclosure, and having research like this that can feed into those decisions is really important. So thank you.
Thank you, Anne. And perhaps to get a preparer's perspective next, Adam, you've been on a lot of different, worked in a number of different corporates and groups, which no doubt have some complicated goodwill and impairment considerations. What's your experience of this?
It's an odd one because it differs company by company. And it's great that we've got 163 people on here talking about goodwill, or willing to listen about goodwill, but that's probably the extent of the people that are genuinely interested in it, because it's, with all due respect to the professor who did some great work, but it's an accounting construct. We don't have companies out there buying and selling goodwill. It's something that arises from a business acquisition, so we're talking AASB 3, that you can't quite put your finger on, or at least the accounting standards can't quite put their finger on. So then trying to adopt an impairment approach for goodwill, or something that we haven't been able to put our finger on, is inherently going to be difficult. So the standard, interestingly, talks to some examples that might make up goodwill, assembled workforces, customer relationships, and synergies, etc. And we're all very good at talking about those in our company reports, but then linking that with a value is very difficult. And then making an assessment of that value time after time. And take the point about when new CEOs come in, you know, very, very different judgments might happen, and then you get a very different view on the valuation. That's inherently what's going to happen when you're valuing something that's kind of fluffy. But yeah, massive difference between companies on how they assess, how they value, and what they think's included within goodwill. That's
really interesting, and certainly one observation I've heard over the years is that the way that the current model breaks down and dissects businesses to allocate goodwill to cash generating units is quite a marked difference from how a company or investor or other would look at the synergies and the bringing together of business units to create value. So that's, yeah, I think that's, but we'll come to Martin in a moment in terms of how investors look at this, but perhaps finally on this question, Janaya, from a corporate finance business, how is your experience with goodwill and impairment? And I'd love to unpack some of the challenges in the valuation and the estimates and sort of forecasts.
Yeah, so firstly, I agree with what a number of people have said around the post-tax discount rate. And I think Moana defined it quite adequately that people who specialise in valuations don't agree with the pre-tax discount rate. And there are some technical reasons for that. But I think one of the biggest challenges when it comes to impairment testing, particularly from a preparer's perspective and sort of us as either the expert or an auditor's expert, it's around that forecasting piece. I think someone mentioned earlier crystal ball gazing. And in this case, there's an element of, getting that right and having that perspective and for the preparers to really actually understand their business and their market fully to be able to then adequately forecast so that then it is representative of the value in use, as it is in most cases, of that CGU and therefore the goodwill. What we tend to see, which is a little bit contrary to some of that research, and perhaps that research highlights what's ultimately been through the audit ringer, for want of a better word, is that delay in impairment testing is often driven by overly optimistic cash flows. And so therefore there is a little bit of a challenge in terms of trying to get the right discount rates and the right growth rates to then actually define what that goodwill and that value of the CGU actually is.
Thank you. Thank you, Janae. It's a great segue, actually. I'm going to, Martin, from the investor perspective and the user perspective, the challenges, how is this as challenging from your perspective? But maybe I'll bring in the following question we're going to look at as well, which is how do you and investors use this information and see it?
Yeah, it's a really interesting one. So our clients are investors. We spend a lot of time trawling through company accounts to look for interesting insights into management behavior. And so I'd say most investors will not look at the goodwill note other than to see how much there is. We, though, spend a lot of time looking at it because we think it's useful information to touch on points raised by a number of people about management teams' willingness to wrestle with reality. All of my colleagues have particular favorite companies where discount rate changes or revenue growth rate or earnings growth rate assumptions become increasingly more heroic for troubled businesses that were bought by incumbent management. And so I think to the extent that investors use this information, they use it as a test of, I wouldn't say management quality, but management straightforwardness. Are you making heroic assumptions in order to preserve the carrying value of intangibles and avoid a mistake? Avoid admitting an error, I guess. And so that would be the way that investors would view this information.
Thank you, Martin. So it's a signal. It's giving you a sense of something. It's not necessarily something that you're feeding into your model.
No.
Yeah.
No. And I think, I mean, occasionally I've seen it, you've seen astonishing changes in discount rates for particular segments year on year. I was just dragging up as Mark was going through his presentation, my personal pin-up company for interesting goodwill disclosures. And so they have changed, interestingly, for one particular segment, which has got their most goodwill and is quite troubled. They have changed both how they value it this year, from value in use to fair value less cost to dispose, and they've abruptly moved to a post-tax discount rate for that one, but none of the others.
Mm-hmm. How do you think investors that you work with feel about the fact that this is, and I'm going to be heroic myself here, I think, from my observation, this is what the most money, time, effort gets spent on in financial reporting worldwide,
Yep.
Possibly to the point where it's 50% of audit costs, regulatory costs, etc., versus everything else. How do you think investors feel about how that's?
I don't think they think that's a rational allocation of costs. So anything that could be simplified to do that streamlining, I think they'd much rather focus on basic quality of financial reporting and clear disclosure. My clients, though, are almost universal, and I think this has also been the feedback from the user advisory committee into AASB, certainly the meetings I've been on when this has come up, that despite all of that, they are pretty attached to the notion of impairment, like that goodwill cannot be amortized, simply because they view it as a scoreboard.
Well,
that its eventual mark to reality. And they're very cynical about the big bath, but I think they just view it as a kind of, well, at least we finally get a fess up.
We've got a question actually about amortization in the chat. Why don't we just bring that back? Simple, easily comprehensible. And in fact, a sneak preview of the Chartered Accountants IFRS survey for this year, about a third of the respondents thought amortization was a really good idea to bring back, mainly because it's more simple and practical. About a third don't like it. Impairment testing is important and it reflects economic reality better. Well, depending on your views of how heroic that, or the different versions of reality, I suppose. And the rest sort of didn't care or didn't really know. And there's also a point in the Q&A pointing to Hans Hugervorst, former chair of the IASB, who perhaps at times has flippantly floated, just going right back to expensing goodwill at acquisition, which is maybe the other end of the extreme in terms of simplicity. But
there was actually an Australian company, Soul Patts, when they bought Milton Corporation. They paid a premium for a listed investment company, and then they impaired that goodwill immediately. So they effectively did that.
Well, I guess the option's open if, for companies as a collective action, perhaps. I would like to go to Anne in a moment about where the IASB got to, but perhaps first, if we can play with that idea for a moment on the panel, it's, around amortization or even expensing. Moana, what are your thoughts around that concept?
Well, I mean, both of those are obviously simpler options, but if we're going for full simplicity, then really I think you'd have to go expense on acquisition. And the reason I say that is, even for those of us with enough grey hairs to remember the days before goodwill amortization disappeared, it wasn't just you amortize over 20 years, it was you amortize over 20 years and you test for impairment if there is an indicator. And my experience of entities that do not have goodwill, so they're not required to do annual testing, is that actually the debate over is there an indicator here is quite significant in itself. So if we said, okay, do amortization of goodwill, but then you must also do some kind of indicators analysis every year as well, I'm not sure how much work actually gets taken out of the system. Expense on acquisition, well, I mean, easy, right? And you say year one, this is the number, but does it reflect what management are doing and why it's there? Coming back to Adam's point about, well, what is goodwill anyway? And maybe Adam might be next in the queue to give his thoughts, but entities do pay the 200 million for 50 million of identifiable assets because they believe it's worth something. I think to suggest that somehow that all should go through P&L every year, the only advantage of that is simplicity. I'm not sure it has anything else going for it, in my opinion. Adam?
Yeah, I agree. The slight paradox there is that what they're buying and what the standard refers to as potentially making up goodwill are things that have a finite life. So our assembled workforce is amazing, but they're not going to live forever, as much as we would love them to. Our customer relationships, as much as we want them there forever, our customers are going to change. So those things that we are buying that make up that goodwill are naturally going to wane. Even the synergies you expect to get, there's only a certain amount of time before that kind of competitive advantage or that synergy remains, before somebody else makes another call. So potentially the option, depending on what the underlying nature is. But I don't see there, and I take the Soul Patts example as probably the one-off where they were able to go that extreme, but it's very difficult to make a call in front of your auditors right now to go, oh, well, we're just going to write it off. No, and you simply wouldn't. And equally, you can't do a gradual impairment of goodwill because that's a bit nonsensical as well. So it's got to be either a allowed systematic way of amortizing it, which doesn't take away the fact that you would still need to assess the recoverable value of the business on an ongoing business in the same way you do for your property or your other assets. But it does allow for that risk maybe to decline over time, that you're going to take an impairment as it integrates into others. And Amir, I know that you and I have spoken about this before, but where you buy a business and slowly it integrates into other pieces, or you buy it with a view to enhance another business, Martin, what you might see is a scorecard that's only demerit points. I'm not getting ticks for good driving, but you are taking it for the few times I've gone a couple of Ks over the speed limit. And rightfully so, you can scold me for that. But there's no opportunity to increase the value of things you've created organically, or for businesses that, hey, we've created value there. So there's a couple of conflicts there.
Yeah, it's certainly. I mean, we did a piece actually with Professor Wallace and Pinnock a few years ago. The name of the report was "How Long's a Piece of String?" looking at impairment testing. And in fact, Mark, correct me if I'm wrong, I believe that report looked at a period of about 15, 20 years. And we did see that the impairment, the reduction in goodwill through impairment, looked like it was pretty consistent and, uniform over about a 15-year period, almost to the extent that it was, looking a little bit like amortization. Is that a fair characterization?
Actually, that was just Matt that did that report.
Oh, okay. Well, there you go. That shows how. Yeah. I won't put you on the spot then, but we should share that report, and that was one of the data points that that brought me into the thinking around amortization potentially reflecting economic reality and just simplifying. But Janaea, what are your thoughts? You know exactly how soft some of these assumptions are, and do you think that maybe simplifying, just writing it all off, or amortizing might be the way to go?
Yeah, look, I think there is merit for the impairment testing process, and I think I want to touch on what Adam was saying earlier, that when you are actually acquiring goodwill, you are acquiring a number of things, and some of that is the potential. It's not just the customer relationships; it's that potential, whether it's synergies or whether it's growth. It is the potential that you're acquiring. One of the other benefits, which you don't see in the reporting, it's actually a benefit to management in terms of actually being able to assess where they're at and how that acquisition has been tracking. And so where you do get that gain, there is no impairment. It's not reflected in your accounts, which is unfortunate, but there is that ability for management to be across and being able to measure year on year what the performance of their acquisition. So I think from a management governance point of view, I think it's actually really valid to maintain the impairment testing, because impairment testing isn't just about the downside. What's reported in the reports is the downside, but from a management point of view, it is looking at the upside as well.
That's an interesting perspective. Now, we do operate within the reality of the world, and as I mentioned, it is very split. We're split on this panel in already just that discussion about this topic. And for your sins, as a member of the AASB, I think you've heard very strong views on all sides of this, and that's landed with not adopting amortization at this point. What happened there? What's the view?
Well, Amir, certainly the views are very split, as you've said from your most recent survey, and you can hear the threads of it as the panelists are speaking. Globally, people are split, and they've got some strong views as well. Now, there are some very strong arguments that can be put into play for having an amortization plus impairment model, and Adam alluded to finite assets that are wasting assets, and companies know they are and would have the preference to write them off. So that was something that was considered by the AASB. Moana talked about the indicator, the pressure that would come on the indicators, And at one stage, the AASB considered whether to switch to an indicator first, so there could be a chance where people just did indicators, not a mandatory impairment test. And people pushed away from that and gave lots of reasons why they didn't want to go that way. So it doesn't matter which piece of this puzzle that gets picked up. There's good, strong arguments probably on both sides. And that made it very difficult. Something that happened so as the IASB was reaching that decision, which sits at the moment as a tentative decision, but I expect that it will not get discussed again in this project. I think it is the decision. And that was the position of FASB, because at one stage it looked like FASB would take the decision to bring back an amortization plus impairment model. And then that would have changed the thinking of some of the board members who are very conscious of not creating differences between IFRS accounting and FASB US GAAP accounting. So, but at that time, FASB changed its position, which gives you an indication that whichever set of board members, whichever board you're looking at, there'll be a variety of views and boards have to make decisions. And FASB said, no, we're not going to change. And that gave impetus for the IASB to say that it would not change. There are so many arguments pro and against. And then you sit down and you say, well, what is the cost of making the change? You know, you're still going to have 50% of your people unhappy with the change. Plus you put a lot of costs into the system. Plus you still have judgment elements. So on balance, the IASB didn't think it was the thing to do at the time. That is not to say if it was a clean piece of paper and the IASB was starting up again, that you wouldn't get a different position. I think the panel's already alluded to the fact that this is an accounting business. It's not something that investors generally get excited about or pay any attention to. Martin has explained the element of it that has information for investors. But in terms of, if you've listened to Nick Anderson or any of the investor board members talk, this is something the accountants or the preparers get very excited about, not investors, not so much. And we're thinking about decision useful information for investors. Yep.
Thank you, Anna. It was clear that the IASB had heard that there were real challenges here, and that conundrum and conflict between, you know, not particularly interesting for investors, however, you know, extremely time consuming and a lot of effort going into it. Professor Wallace pointed to some of the simplifications that the IASB has put forward, but Anne, did you want to just in a nutshell sort of touch on what do you think are the most meaningful simplifications that the IASB is putting forward at this point?
I think it's very helpful that we've had Mark's presentation today, because he touches on the comments on the end in his presentation about the sort of things that the IASB might change. I think you have to realise that the decision was made after a lot of thinking by the IASB and consultation with stakeholders, that the IASB didn't see a way to make a new impairment model. So we've got to work with the old model. There didn't seem to be interest in scrapping the current model, even though there's so much unhappiness with it, and creating a new model. Years ago, the IASB and other standard setters looked at something called the headroom approach. And if you think impairment testing complicated, just layer in some headroom. And that didn't fly. So the decision was made that it would not be a new impairment model. They couldn't see a way forward there. So it had to be tweaks on the existing. And so I think there's a lot of consensus around the post-tax rates. Mark mentions a couple of other areas that he thinks that that the IASB could also incorporate. They're not in the suite of proposed changes at the moment, but I think they're useful, and this information I know will flow through to the IASB. There seems to be a bit of the split views on the ability to include in the future cash flows changes that are going to be made into the future. Some people were very supportive of that, others less so. And the idea of allowing those changes in the future cash flows, so future changes in operations to be able to be in those future cash flows, it was to make the prediction of the cash flows easier for entities, because the board heard that that was a process whereby cash flows are done and then they're adjusted to take out the enhancements. So that it's got a lot of supporters for it, but again, some people are worried about the pressure that will come on auditors around that.
Mhm.
I think Mark's work is interesting, what it tells us about where the areas of conservatism are, where the areas of optimism. And you will always get that. And I think we've also heard in the panel that it varies by companies. In Mark's work, you can see some companies are incredibly responsible in what they're doing, others less so. So I think that there are some changes in there. The business of putting the CGUs, identifying which segment they're in. So the idea there being that more disclosure when the companies are obliged to make those disclosures, then the investors can see the information. It is a way of holding them more accountable. One of Mark's points is that there is some disclosures that are simply not made. And if external people, investors and others, can't see the information on which the decisions are being made and the judgments that are being made, you can't hold people accountable for things that you can't see. So there are specific proposals that are aimed at improving the impairment testing under IAS 36, but there's also recognition that the impairment testing itself won't give investors all the information that they actually want about how the acquisition performed. And that is why there's the second part of the project, which is about disclosure of post-acquisition performance. That's not our discussion for today, but that's a big area of the work. So it does look that the changes to IAS 36 seem to be relatively small in number, but hopefully they are going to address the very serious concerns about the costliness of impairment testing.
It sounds like a really, a genuine attempt at simplifying, but within quite a constraining sort of set of circumstances. Adam, at the shop floor, does anything stick out there that'll sort of make a difference?
Absolutely. The comment about being able to include strategies and plan changes. There was very limited circumstances where that could be they could be factored before. It is how we think about when we're valuing our businesses, things that we've got in play, as well as things that we're going to put in place. So it links the two together. So I agree with that. And the post-tax discount rate was a slam dunk. If they didn't change that, there were issues. So these are, and I agree with what you said, Amir, they obviously had a very limited breadth that they were able to, of changes they were able to make. So these were good ones to make.
Oh, that's really positive. Now let's go to a few of the questions, and please do keep those coming through from participants. There is a cluster of questions around economic reality, some of it sort of dipping back into amortization, but talking about the fact that goodwill is a residual from a commercial transaction. Does it really meet the definition of an asset? But then also, why is there so much goodwill impairment? The old argument for not amortizing intangibles is that the business is growing. So why aren't these businesses growing, and is their acquisition failing? I guess on that basis, the goodwill should be there forever. But Janaea, what are your thoughts on that from a valuations perspective?
Yeah, so I think it's important to know where there's goodwill impairment, it doesn't necessarily mean that the business isn't growing. It's just not meeting the expectations that they had at the time of acquisition. And so there is a distinction there. And some of that, and I think this also goes back to that point around economic reality versus, what you can do in that reconstruction or those specific projects you can include or can't currently include in value in use. So, for example, there is that risk of day one impairment where, as part of that purchase price, there is an assumption around certain things you're going to deliver. If you're not allowed to do that under a value in use standard, that's naturally going to lead to an impairment because you're not going to reach those forecasts upon which you based your acquisition price. So that's one of the challenges, and that's why I can understand that request to have some of that restructuring type assumptions being factored in, putting aside the challenges associated with the forecasting, the auditability of that. But there are a number of other reasons. So one is that it's not performing as expected. There can be market changes. So a COVID is a perfect example. So, you know, when the market around a lot of businesses changed, then naturally they're not going to reach their forecasts, and therefore the goodwill impairment would occur. But again, just to reiterate, it doesn't necessarily mean that the business isn't growing. It's just not growing at the rate that was previously expected.
You know, Martin, you pointed before to, you know, bringing a healthy skepticism to the assumptions, which you know, we would love as accountants and auditors. Professional skepticism is one of our, you know, key principles. But how do you view this question around, you know, is it a bad thing if an impairment happens? Is goodwill expected to last forever if they made a good decision, or are there other factors at play?
I mean, there will be other factors. I mean, I often think about script-based mergers, where, you know, corporate finance 101, when you use your script, that's an indication that you think your script is overvalued and you use it to buy something. The one I always think about is when Newcrest bought Lahire. Script-based merger, many of the shareholders of the companies were actually the same. Now that ended up with a gargantuan impairment. But to a certain extent, that was like, well, I mean, the acquisition was not a success, but most of that's illusory anyway, because it was script. Investors get very focused on when you have spent cash for something. And so I think if you'd had an investor on here listening to some discussion about, you know, it's an accounting residual, an investor would say, well, it's an accounting residual that represents cash. Like, it's, you know, that's actual cash money that we borrowed or spent.
Yeah.
I think a lot of the pushback, for example, about being able to incorporate assumptions into goodwill impairment testing has come from investors, because they're just sitting there going, oh my God, that means we're never going to impair anything. But again, impairments are not always a bad thing, and often investors welcome them because they're a sign of like, oh, okay, you have faced up to that didn't work. And sometimes they are just a consequence of the world has changed. That, you know, that business that has been sitting and performing, that we bought 20 years ago, well, we've finally decided to exit it because it makes Melways and everyone's got Google Maps now. That's just life. That is just the economy working. I mean, to reiterate, investors are very cynical about the big bath of a new CEO. It's kind of almost expected now, but to a certain extent, also that's why you bring a new CEO in to confront the things that have gone wrong and clean the decks and move on, because it's easier for an outsider to make those decisions. If I could just make one point about investors, there's a weirdness about investors and their kind of support for maintaining impairment rather than amortization, and their willingness to look at a concept like NPATA, so looking at a profit number that excludes amortization of acquired intangibles. Because I know from talking to management teams, there seems to be, other than those who just try and do their best to allocate them fairly, there seems to be two schools of thought. One is create as big a bucket of acquired intangibles as we can, because we can amortize those and get rid of them, or create as much goodwill as possible and preserve it. And I can think of a couple of companies, either one. And from investors who are saying, no, we like goodwill because it's a record of what you spent and sits there as a constant kind of score, they seem to be completely willing to allow people to come at it the back way of just recognizing a lot more acquired intangibles. And I've seen this where acquisition accounting gets completed in businesses that are struggling on an acquisition that already looks like it should be impaired. And when they finish the acquisition accounting, the split between goodwill and amortizable intangibles has changed radically in the 12 months. And so there's this weird blind spot in investors saying, well, we don't want you to be able to amortize goodwill, but sure, call it a customer relationship and we'll put that below the line when you amortize it.
That is really interesting. That goes back to that whole conversation, doesn't it? But
Yeah.
Adam, you sort of hinted at this a little bit earlier in terms of the synergies becoming absorbed by the greater business almost over time, and that being part of why goodwill might decline. when it's dissected into cash generating units. What's your view on that value does get impaired? Does that always necessarily mean that it was a failure of the acquisition, or are there other things going on there potentially?
Yeah, there's certainly other things at play. You think about the example of a map book, and now that we've got Google Maps, but if they had gone and invested in a digital platform that allowed them to convert all of that into digital maps, and they're able to run that business, and it was a separate CGU, well, then they write off their maps business, or sorry, their paper business, and then they've got this digital business that they've started organically that is now 10 times the value that would have been able to sustain that goodwill, but because of the way they report, they have to write it off. So you get that in just there. I appreciate though what you're saying, Martin, is that the investors that are probably caring enough, they're going to understand that and be intelligent enough to have picked that up and gone, hey, notwithstanding your write off $100 million that you spent in 1995, you've made a couple of $1 billion, and your market value or your fair value reflects that. So there is that balance there. I don't want to get into a place where we're writing things back up or fair valuing goodwill up. If we're saying we're already using 50% of people's time measuring and managing goodwill impairment assessments, then this is going to be 120% of their time. So the only other point when we're talking about acquisition, and if it's a struggling business when we take it on and we're not able to build in the strategies that we're going to implement, that risk of impairment, if you're using value in use, that's kind of almost entirely offset for that first 6 or 12 months, depending on the cadence of the business, because you've gone out and you've paid that for the business. So your fair value less cost disposal, or the fair value, it can probably cover that for a period of time. I'm interested to hear other people's views on grace periods for goodwill before you might start amortizing it, because certainly now businesses can change, like you mentioned, with COVID or with new technology. That goodwill that you bought yesterday can be almost dead the following day.
Well, we all know where marking things up on the balance sheet can end up from a few decades ago, but it is naturally one of those asymmetries in accounting, isn't it? That we're recognizing externally purchased assets, but not internally generated ones. And I'm not suggesting we should, but certainly that's potentially part of the discussion. You look at that chart that I'm sure we've all seen with 1980s, 80% of market value represented by the tangible assets of the organization on the balance sheet, and then current times less than 20%. So that's part of the challenge here. There is another great question, actually, looking at ESG and climate. And now as that reporting becomes, it's mandatory now and starting to roll out across different groups of entities in Australia, how are climate-related risks and ESG factors being integrated into goodwill impairment assessments? Perhaps I'll throw to Moana first on this question.
Sure, but can I be cheeky and speak to Adam's point about grace periods?
Sure. I'd love to. Yeah, please do.
So I agree. So usually in the 12 months post an acquisition, you would say, well, that is what you paid for it. So there can't possibly be an impairment. That must have been the market value, especially if there was more than one bidder. Happy days. And interestingly, just in the last couple of days, right, we've seen Myer come out with their results and say, because the accounting standards require you to fair value shares at the date of acquisition, if for whatever reason your share price, which feeds into your purchase price, was elevated for any reason at the time of acquisition, you can very quickly generate an impairment. And that's what I think they were trying to say, perhaps, has happened in their apparel business that was only acquired last year. So we do see entities coming out quite quickly to say there's a problem. It's very hard then if you get into, okay, it's more than 12 months ago, it's not all going to plan, but most turnaround plans don't move as fast as one would hope, right? I think we can acknowledge that in practice, that there's always a stumbling block or something we weren't expecting or so on. So there is a reasonable, period for which you could say, okay, we can probably hold that thought for a minute, but we can't hold it forever. And as Martin has said, the assumptions required to hold that thought get more and more heroic as forever goes on. So if you're hoping I was going to say an exact period, I'm going to disappoint you, Adam. But I do think it's a really good question, though, right? Because there is a point in time at which a cynic would look at a business and say, that's, we're in trouble here. And an optimist would look at it and say, hold on a second, there are lots of levers I can pull to turn this thing around. Don't tell me I need to impair right now. And there's, there's probably a period for which there isn't a right or a wrong, I would have thought, in that, before it becomes clear that actually there's only one answer. And on the question you actually asked me, Amir, sorry, about ESG and how we consider climate-related risks in our impairment testing. The people who do read Goodwill notes, and perhaps that's just the people on the panel who are on this webinar already, will have noticed Australia's largest corporates have already started making statements about the assumptions and whether or not they are seeing a direct climate-related impact. So the example I always give is, if you've got a hotel that is on a beachfront somewhere in the Pacific, you probably have a direct impairment risk that you can identify and explain there, whether it's today's impairment or tomorrow's, you can see it. As you get, though, into the really more complicated businesses, it does get hard, but also some of the stuff is already built in. So, for example, a lot of commodity prices already have some kind of climate-related risks built into them in terms of the key pricing that you can get out of the main pricing houses. So it's actually very difficult to find that point at which could you say any impairment model in Australia just ignores climate and has nothing in it already? Probably not. A lot of the inputs are already making assumptions there. Then when it comes to the more direct, I've got a hotel on the beachfront in the Pacific, we haven't seen so much of that as yet, but I think it is coming. And as the person who asked the question, I think, was rightly saying, because climate reporting is becoming mandatory in Australia, there's a lot more in the front half about what do we think, where do we see our risks and opportunities, all of that does need to actually match up and play into the back half of, okay, so what's the implication of that for impairment testing? If I think at the front that a number of things might happen and I want to talk about them, how have I followed that path into the impairment testing? Will it always be obvious to an investor? I think Martin will look at reports in 2 years' time and say, the link is not necessarily always clear because the disclosure requirements aren't always as clear. So the way the climate reporting opportunities and risks are framed is not the same sort of way impairment is framed. So although that might well be done in the background, I'm not sure it will be immediately obvious, other than through, we know auditors and accountants have an obligation to make sure that these things actually are telling the same story.
I can actually think of 2 impairments in the last 3 or 4 years. One of them involved Goodwill. The other one was a resource company property that specifically cited climate change factors, cost of ACCUs in the assumption as to why it occurred.
Is that something investors are looking for now, Martin, would you say generally, or maybe particular groups of investors?
Particular groups of investors are. It depends on what kind of industry you're in. I'd say the better investors would not think of it as, they wouldn't think of it as a specific bucket. They'd just think of it, this is one of the things that I have to think about when I buy this stock. What is its exposure? And you can see real world examples of that in companies listed on. So I'll give you an example. Horizon, great monopoly infrastructure business, is struggling with the fact that investors are looking at going, well, your primary business and the thing that is fantastic for you is ferrying coal. And so that has a finite life in a carbon constrained world. So, we'll go elsewhere. And then there are investors who are going, yeah, but even given that, you're really cheap. So people are factoring it into models, and then people like us are reading impairment testing notes to see if people are thinking about it in that context.
Yeah, we've at CAANZ, we've been doing a research piece now for about 4 years looking at the number of mentions of with Professor Pinnock, and I think this one is with you, right, Professor Wallace? Am I right there? Yes.
Yeah, we
It's
actually
right.
collected this for this report as well. So we actually collected whether the firm discussed environmental issues as a key assumption, forecasting assumption. So, I mean, I could show you the slide, but basically about 5.1% of firms did in our sample in 2023. And that's been increasing a lot. So it was about 0.7% in, I think, the start of our sample, and then it went up after that. So, a lot more firms are talking about this in the time. It's a key forecasting assumption in the impairment test.
And there's pressure from other observers, stakeholders, not necessarily investors. There's groups watching what companies are disclosing, particularly in Europe and internationally, questioning, challenging, whether assets should be being impaired, and it is a challenge for the profession and companies, auditors, regulators as well, to reconcile both sets of reporting and make sure that as I think, as you say, Martin, it's in context, because investing is different than activism, although the two are starting to come more and more, together. Janaea, are you seeing lots of examples of companies that you're working with having these ESG and climate factors starting to come into play?
Yeah, absolutely. So at the moment, it's still very hard to measure. So that there are some obvious measures. So, for example, we're seeing, if you talk about the coal miner and cost of debt and things like that, there is clearly some financial metrics around that. Anecdotally, it is very hard to measure, but what we are seeing is in things like discount rates, where we are starting to see an elevation in those discount rates to reflect the risks, that future risks on ESG, to the extent that they're not able to be reflected in the cash flows. So I think companies are trying to. I think the reporting will help move forward in terms of having observable benchmarks against which to compare. But until that stage, it is very judgmental still. And whilst we are seeing it, there's probably not a lot of consistency around how it's being addressed in any sort of valuation, whether it be for impairment testing or any other reason.
And this was one of the main things actually covered in the AASB's climate guidance related to financial reporting. And what sort of things did you see internationally around that work?
We saw a lot of trends that Mark's alluding to, which is that disclosures are increasing and there's much more evidence that people are taking climate factors into their impairment calculations. But I think, as Moana has said, there's a lot of things that go on behind the scenes that don't necessarily hit financial statements. It doesn't mean that these things aren't being talked about and considered. And that was a key part of the climate-related risks and other uncertainties projects, that we heard from investors and others that there seemed to be some sort of disconnect between the front part of the annual report and the financial statements. And that's why the examples have been released to give more guidance to preparers on how they might think about bringing in and disclosing more about the risks that are already there and are being considered, and people can see they're being considered because they appear in other materials such as narrative reports. So we observe the trends that Mark has alluded to, and I think that that changing environment has really underpinned that climate-related and other uncertainties project. And hopefully now that the examples are released in draft form, but the final examples should be very close to those draft examples, hopefully that will give more clarity to preparers and auditors and others in terms of disclosures that would be appropriate.
Thanks, Anne. Well, we've just about got to time where we'll need to wrap up. Perhaps 20, 30-second final thoughts. We'll just go around the panel. Moana, did you want to kick us off?
Yeah, thanks, Amir. Look, obviously it's a really complex area of accounting, and I think everyone is waking up with the best will in the world to do their jobs, whether it's investors or preparers or auditors. And yet I think we all still have a slightly different view of what that means. And I think that will be increasingly true as we think how we include climate-related risks and other ESG type matters in those models.
Janelle?
Yeah, I agree with Moana there. From a climate change perspective, it's going to be challenging for quite some time to be accurately reflecting it. But overall, I think what we've talked about in terms of the changes that are being proposed and things like that should simplify some areas of impairment testing. It's not a simple exercise, and I don't think it ever will be. There is a lot of technical aspects to it, and so trying to simplify some areas I think is great, but there is a lot of work that has to go in the background to get the quality.
Adam?
Thanks, Mia. It's a really subjective subject. I think transparency and disclosures kind of trumps it all, because that allows anybody else that's got a different judgment to you to kind of make that judgment and get to a result that works for them or that they think is appropriate. So transparency and disclosures trumps it all for me.
And Anne?
Great to follow Adam on this, because disclosures is the big part of the other work the AASB is doing in this area. So my plea is for people to comment on what the compromises that are being proposed. And even if you agree, making sure that your agreement is registered really helps the board push through and make those changes. And then giving feedback on how the disclosures can work so that the compromise position can be reached would be really helpful. So thank you in advance for contributing.
Thank you. I think it's appropriate to give Martin, representing users and investors who this is all for, the last say on the panel.
Yeah, I'd like to echo what Adam said. The disclosures allow people to make a judgment about whether people are being straightforward with them or not. If everyone in financial markets had the same opinion, then stock prices would be flat all the time. So markets are made by people who have different opinions about value. And so having the best information to enable them to think what is the value kind of solves all the ills. And so my last comment would be a lot of the things I think investors get really frustrated about are derived not from the accounting standards, but from embattled auditors trying to do a lot of different things. So anything that can make their life simpler and clearer is probably to the advantage of investors in the end.
I love that to close out with on Auditor Proud Day. And I think from my perspective, it's positive. There's been real change in the latest IASB, proposals and changes. But there's still a debate that's well worth having. And as we've heard, one that international standard setters may come back to as time evolves. So let's keep having that debate. Thank you for having me, and thank you all for being here. Without further ado, back to you, Sabine, to close us out.
Well, thank you so much, everybody, Mia and Mark, for the great presentation and the hosting and all the panel members. It was such an interesting discussion. I've learned so much, and I hope our audience has too. And it's given everybody something to think about further as to how we think about goodwill and impairment, and maybe think about what works and what does not work, so we can feed that back to the IASB. So also thank you, of course, for the audience for your great questions. It was very, very helpful to keep the discussion going and also to guide the discussions. Some very excellent questions. And apart from that, please do subscribe to our LinkedIn page or to our newsletter if you haven't already done so. You can also find on LinkedIn, we link to the presenters and panelists. We've had a couple of questions, Mark, about your research, whether that is available. So if we can have maybe a link or something, and Amir, you mentioned the CAA and Z report as well. I think that would be appreciated. And apart from that, I wish those who are in Melbourne a happy long weekend. And to our sports fans here, may your team win. And we'll see you at the next dialogue series. Thank you very much, everybody.
Thank you.
Thank you.
Thank you.
Bye.
Goodbye.